Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. And welcome back to Cash Talk. And today I'm joined by JK. JK, how are you, mate?
Good, mate. How are you?
Not bad, not bad.
Sweet.
Getting back into the podcast after my break, which was lovely, to be honest with you. I just slowed down a lot, which was good.
Awesome.
And get up to much for Easter?
Went down to Wodonga for a few nights, which was good.
Mm-hmm.
Just sort of, explored around a little bit, but nothing too exciting. Just relaxed, tried to wind down a bit.
Painting of eggs, a little bit of...
Actually, no, not this year.
Okay.
We didn't get around to it. Mum didn't do anything either, which was
Strange.
a bit unusual, yeah.
Oh, well, I'll have to speak to her and get her to sort it out. But anyway, let's get into it because end of financial year is fast approaching. We've got only, a month or so away into the end of the financial year, let's be honest. And we want to answer some of the questions that we commonly get asked about preparing for the end of financial year and how you should be looking at this as well too. So I know, JK, you've prepared some questions for me. I might throw a couple your way as well too,
good.
but let's see how we go. So let's get into it. Awesome.
So first off, what should people know about concessional and non-concessional and catch-up super contributions before the end of the financial year?
What's interesting is a lot of these superannuation contributions are dictated by starts and ends of financial years. They're essentially deadlines in which contributions need to get done. I think the first thing is around these contributions. We need to be mindful if we're putting them into superannuation that there's also deadlines in regards to when this money comes in. Okay, so for most people, you don't want to be putting the contribution in on the 29th of June. Okay, you want to be putting it in a little bit before that. And most superannuation funds, especially retail funds, will have a cutoff date. Okay, so it's very important to check with your superannuation funds the cutoff dates, okay, because they will then be the point in which you have to get the money in, okay? So even think about like BPays and stuff like that. It sometimes takes delays for the money to leave your account and actually get cleared into these people's accounts, and that's what matters. So that's first one. Second one is around what contributions are what and how they play. So first and foremost, there's concessional contributions, okay? Concessional contributions, for all intents and purposes, are tax deductible super contributions, okay? Now, JK, there are some limits in regards to concessional contributions that people need to be aware of. And so what's the current cap in regards to concessional contributions?
Yeah, so the current cap at the moment is $30,000 that you can put in each year. Now, that is a combination of what you put in yourself, but also what your employers sort of mandated to put in as part of those super guarantee contributions.
So if your employers put in 20 grand for the year, for example, you can only put in 10. Yep.
Yeah, spot on. So that's essentially the big one in regards to the caps.
And then there's also this catch-up that's been introduced a few years ago. And this is something that we work in combination with other strategies, okay, which is very important. But for all intensive purposes, you can catch up the last 5 years worth of financial years unused concessional contributions. Now, it's very important for you to be aware that first and foremost, you go onto the MyGov website, you'll be able to see the concessional contribution that has been used over the last 5 years. If you don't and you work with an accountant can help you with this information. However, what's very important, JK, is that the concessional contribution cap has not been $30,000 for the last 5 years, has it?
Correct. No, it's some of those financial years that are included in the last 5 years, the cap was as low as $25,000. Then it sort of went up to 27.5, and now we're at 30,000. So that's important to keep in mind as well.
And also as well too is that the employer contributions through that period have gone up as well too. So you got 11.5, it's going to 12, and before that it was 11 and 10.5 and so on. So there's been moving parts over those last 5 years as well, but what happens is at the end of the financial year, as soon as you cross that amount, okay, the first of those 5 years obviously drops off, okay, because now the next previous 5 years. So if you're not looking to access it, just be mindful is that fifth year, okay, in the past will drop off. But JK, it's also not eligible for everyone, is it?
Yeah, correct. So your balance has to essentially be less than $500,000. as of the 30th of June of the sort of previous financial year, so that June that sort of just passed. So that's a big one to keep in mind. If you're $1 over that, then you're just not eligible to use those catch-ups.
So, for example, if you're getting to this end of financial year and your balance is kind of getting close to that 500,000 and there's a risk of it getting to 500, it's something that you definitely need to kind of consider because you're then not going to be able to use all of those unused as well.
Yeah, 100%. And it's not that you need to use it. It's just more around, hey, this opportunity is going to disappear. So with, your situation outside of super, what that looks like, can you afford to put those contributions in? Something definitely worthwhile considering, at least using some of it if you can't use up all of it.
Awesome. Now, also, JK, while we're on the concessional contribution topic, one thing that I wanted to also talk about is end of financial year planning around like CGT events because they kind of work into one another. We will get back to non-concessional contributions, I promise, but I just want to kind of touch this because it is a topic that happens. And JK, let's just talk about a few things. So let's say someone sold an investment property. Okay. First thing is to know when it comes to the CGT event, just a reminder, it is the actual contract date, okay, not the settlement date. So, let's say you've signed a contract today, that settlement, even if it's in 90 days from now, it doesn't really matter. It's the contract date in which a CGT event applies, okay?
And that's a really important one. Like we've got a client that we're working on at the moment and the whole idea was around like they've got an investment property. It's not very good from a cash flow perspective and it doesn't actually align to their goals. So we'd actually recommended that they go off and sell it. Now, when they do sell it, we've already sort of advised to use those catch-up concessional contributions. But around the timing of the sale, we're trying to get the contract date in July because they don't have enough essentially cash to make the contribution now. They need the funds from the sale. If they sign the contract in June, settlement's usually not for at least 30 days. So if they sign the contract in June, we're kind of not going to have the money to put the contribution in before the end of the financial year. So that one's really important as well.
And so timing and planning, very, very important. And so obviously you've alluded to the next bit around using these concessional catch-ups because some people might even have, 80, 90 grand's worth of unused catch-up concessional contributions.
Correct.
And what that enables you to do is essentially when you have a capital gain, let's say you've got a capital gain of $100,000, okay, after the CGT discounts, you're left with $100,000 capital gain. That capital gain goes on top of your taxable income. Now, let's say, imagine you had $80,000 worth of unused concessional contribution caps. What you're essentially doing is bringing your taxable income down by $80,000. And so that 100 gain is now 20 gain, okay? Now, don't get me wrong. Concessional contributions also, when going into superannuation, are taxed at 15%. There is other rules that apply, but we won't go into full details. But for all intents and purposes, there is a contribution tax as well too. Yes, it's not applied on your personal tax returns. Yes, it's usually more tax friendly than your marginal tax rates, but it is something to be aware of when doing these things. And also as well too, to bear in mind that once you put the money into super, you've also got to wait until preservation age, which is 60 years of age as a minimum, to be able to access these funds. So it shouldn't just be a tax play. And this is why advisors are licensed to give advice in regards to contributions, and accountants who aren't financial advisors, aren't licensed to provide you with how much to put into superannuation, because it's both a tax consequence, but first and foremost, it's a retirement decision. It's a lifestyle decision. It's a cash flow decision.
Yeah, 100%.
Now, that capital gain event can happen from any assets pretty much that are investments besides your PPR, okay, or your principal place of residence. So I want to go back now, JK, to just non-concessional contributions, which is the kind of sometimes forgotten brother of the concessional family. Now, there's a few things that we do in the non-concessional space. First and foremost is for people that are considered of low income, okay, is to use the $1,000 for the government co-contribution. They give about 50%. So for every dollar you do up to $1,000, they give you $500, which is pretty cool.
Pretty good.
Yeah. 50% return on your money. I'll take that. But as well too is around we look to sometimes put non-concessionals in for certain reasons.
Yeah.
JK, what's some of the reasons that we might use non-concessional contributions for people?
Yeah, that's a good question. So a big part of it is if, say, we've got someone that's getting close to retirement and we've built up like a nest egg outside of super for, if they needed to retire early to make sure that we've still got access to those funds. As they get closer and closer to that age 60, we want to start channeling the money over from outside of super to inside of super. So those non-concessional contribution caps give us the opportunity to do that because there's a larger cap. It's about 120,000 that you can put in every year. So that's one of the reasons why we might do it. Another reason is around recontribution strategies for people that are retired to try essentially wash out what we call the taxable component and increase the tax-free component inside superannuation as much as possible. Doesn't really impact you if you're retired and over 60. But it's more for, when eventually when those benefits get passed on to, say, for example, your children, they get taxed on the taxable component. So it's around just trying to get that taxable component as low as possible and having as much tax-free component in your superannuation. I'd say they're probably the two main ones why we do it. Another one could be, like you mentioned, around the sale of an investment property or the capital gains tax event. Yes, you're not getting the tax deduction on those contributions, but you've got these proceeds from the sale that you just want to move into a more tax effective ownership.
Yeah, definitely. And just to clarify, when you're around the taxable components and tax-free components when you're doing a recontribution strategy, the main thing is that when superannuation gets paid when you pass away, does it go to a financial dependent or does it not? Okay. And in most cases, if it's a husband and wife, let's say the husband passes away and the superannuation goes to the wife, she is considered a financial dependent and or under a CISAC dependent, okay, and in most cases tax dependent as well. What happens is the money flows from superannuation to her, completely tax free. In most cases, there is untaxed components that can at some point be there, but for all general purposes, that's usually the case. However, let's say you're in retirement and you've got adult children, 25, 26, whatever. They're no longer considered financial dependents. And so what happens is that there's usually a taxable component, which is usually contributed from the employer contributions that have gone to contribute into that super fund and salary sacrifice and essentially concessional contributions, okay? There will be a taxable component. And if they were to receive the superannuation, on that taxable component, there is a death tax, okay? And so what that strategy that JK was talking about before, you're trying to wash down that taxable component and lift up the tax-free component, and that's what non-concessional contributions do. Yeah. I think the other one as well too, JK, is around obviously if there's timing, not necessarily end of financial year because there's other things, but there are other contributions as well too that we do look at. Small business tax concessions, okay, when we used one of them, which is around the retirement, around putting money into superannuation. There's obviously timelines in regards to that, especially when you're working with your accountant. If you have done small business tax concessions, usually there's certain deadlines in regards to the end of financial years when they need to be done, okay, based on previous agreements that you've done when you've put in these exemptions or these concessions. The other one is around downsizer contributions as well too. But downsizer contributions also, there is a timeline once the downsize have happened for that money to go into the superannuation fund. Not really dictated by end of financial year, more dictated by that date in which the downsizes happen.
Absolutely.
And also the other one is first home buyer super saver as well too. So first home buyer super saver scheme allows you to put contributions into superannuation that can help you to tax effectively build up a deposit for your superannuation.
Yeah. This is a really good time to look at doing that as well because normally, say for example, you're at the start of the financial year and you're looking to buy a house sort of in the next couple months, you could only really kind of put in one lot of $15,000 that you can take back out. But if we're in June or, getting close to June, you can kind of go put a contribution in, say on the 30th of June, then you can do another one on the 1st of July, and then you can apply to release it straight after that. You've kind of done 2 financial years of contributions within the space of a few days.
Yeah.
Whereas, if you're in September and you're looking at buying over the next couple months, you can kind of only do one lot.
I'd probably do it before the June 30th.
Yeah, no, of course. But
I get what he's trying to say, okay? So, no, but yes, very good. Yeah. Very good. Yeah, so there's obviously a lot of other ones in regards to superannuation. That is a fair bit in regards to super, and we've obviously tied in some CGT events.
Yeah, absolutely.
What's some other questions, JK?
So for self-employed individuals, what's a tax-effective way to approach structuring at the end of the financial year?
So I think one of the big ones is that if you're working with an accountant, to start having some tax planning conversations as well. So, especially I know with myself and the accountant, we're regularly talking. We're probably a little bit of an anomaly in regards to our tax planning. We're very live in regards to it. But, February, March, you should be having conversations, probably even April in regards to what am I doing before the end of the financial year? And if you're self-employed, you're looking at, what's your profit margins? Yeah. What kind of asset protection do I need? Like, have I built the business to a point where, I now need to start looking at more sophisticated structures. You might be in a partnership, a sole trader. You might be running a family trust, and you might want to start exploring things like bucket companies, or maybe moving away from a particular strategy, and that kind of ties into those small business tax concessions as well. Like the government actually, as you grow and as you develop as a small business, give you these concessions to potentially look at restructuring as well too, not just for selling as well. But yeah, I think structuring is something that needs to be done, and also that there's a pulse check on your structuring every year. I know, for example, with myself, we've introduced another entity into our grouping structure because there ended up being between some certain companies and some certain trusts something that we didn't like. The way that the money flowed. And so we need to reintroduce an entity to kind of fix up and tidy up that structure, but. I'm moving from an old structure to a new structure, and that takes years. So structuring is very important, but it's not necessarily a set and forget. As you grow and as you evolve, you need to do that. Now, obviously, with the end of financial year, it works sometimes good to, if you're going to introduce new structures, to introduce them at the start of the financial year, so you're not doing two financials, two tax returns. So, yeah, it's definitely a conversation around structuring. But I'm sure you want to chime in on this too.
Yeah, so I think structuring is probably the biggest one. The other one is just around, like you said, understanding where your income's likely to land, because for a lot of, self-employed individuals, you kind of don't necessarily know, or you kind of have an idea. But for example, like even that difference of going into one tax bracket versus another tax bracket, or, going over that 250,000 Div 293 threshold, that can have a big difference on the strategies that you use for tax planning. So it's just around trying to understand that and get that as accurate as possible, which sometimes you might not have a good idea even a month before the end of the financial year.
And how involved, JK, are you in that planning with your clients?
Yeah, especially with self-employed people, like heaps. And it's really around this time of year where there's like, we've got a few that I'm working on at the moment, and you kind of can't do anything until around this time of year, just because you don't know where things are going to end up. And like, for example, there's one at the moment, we're having that discussion about the bucket company with the accountant. And then, well, what do we do with the assets inside that bucket company? How much distributions are going to get paid into that bucket company? All that sort of thing.
And how much does that dictate the decision? Like, obviously in that bucket company, and I'm presuming there's like family trusts that are like flowing that money into that bucket company. Like, obviously companies don't have CGT concessions. Obviously they've got a flat tax rate, which is nice and handy. But that obviously dictates the assets that was in there, but also not just the assets, but then like the way that the kind of money flows too.
Yeah, correct. Yeah, so that does have a massive impact, because ideally you kind of you want income generating assets in those companies, because that's where you're getting the sort of the biggest tax benefit out of it, because there is no capital gains tax discount.
And for example, like you could potentially be having like fully franked dividends from a share portfolio getting taxed at 30 cents on the dollar. They get fully franked, come into your company, at the bucket company, taxed at 30 cents on the dollar, but you're getting all franking credits. So you're essentially paying no tax on that income if the money's held in the company. However, usually when you're getting these income generating assets, you're not getting these capital growth assets.
Correct.
And then usually when you've got these bucket companies, you're working with high income earners.
Yeah, which kind of don't need the extra income anyway. So it can get a bit difficult to work with sometimes.
Yeah, and you've got to step away and map it out. And I know with this particular client, JK, stepped me aside. He's like, John, let's have half an hour to kind of map out which kind of possibilities. Obviously, he did a lot of pre-work before that conversation to have with me. But then around kind of which way we wanted to go with this, do we introduce investment bonds? Do we then reloan the company money like to an investment trust? That investment trust then goes and invests the money. Obviously, for this person's unique scenario, we came up with what we think is the most probable and best solution for the person, based on some back testing against multiple different options. But definitely, it's a lot of considerations.
Yeah, and I think the other thing worth mentioning as well is there's a lot of, and we hear this a lot with like the term negative gearing as well. There's a lot of focus on trying to get your tax bill as low as possible. Now, we don't want to pay any extra donations to the tax office and say what we could have. But we also don't want to throw money away just to save money on tax as well, because tax isn't kind of like the number one goal. It's kind of like the secondary goal. It's like, first, let's map out where we want to get to and how we're going to get there. And then with that, what do we need to do to make sure that that tax bill is minimized as much as possible?
It's like earn the $500,000 but pay $100,000 in tax, or don't earn the $500,000.
Correct. Yeah. So just something to keep in mind as well.
Yeah, definitely. And yeah, that's like for a self-employed, obviously there's a lot of moving parts, but the biggest thing is to be working with, financial advisor, accountant, and really kind of mapping this stuff out. I know we regularly speak to our clients pretty much on a 90-day cycle, and obviously getting the accountant in those cycles as well too really helps with being prepared for what needs to happen before the end of the financial year, before that deadline moves over.
Yeah. So which tax deductions do people often miss?
That's a good one. For me, I look at everything. I don't know if it's just maybe the way that I'm wired, maybe the way that I got grown up, but I look at everything. And the reality is I don't want to give any donations to the tax office. They don't do enough good with my money. I'm sure they don't do enough good with your money. But anyway, ones that are very relevant to us, I think one is income protection.
Yep.
I think that people forget that they do pay a fair bit for income protection to protect their income, which is very vital. Yeah. But, to wait August, September, income protection statements come out, make sure you grab those statements, give that to the accountant, or if you're doing your taxes on your own, obviously to claim those income protection from the statement. I think that's one. I think also just making sure that you wait for that statement. Okay, there's usually like stamp duty and stuff within there. You potentially can't claim the whole amount of income protection. I think as well too, talking about like insurances and stuff like that, like paying them annually, not paying them monthly. Okay. If you just started your policy and it was like 6 months, you're only going to claim that 6 months. Like maybe you might potentially want to kind of claim it all in that 1 year. I think the other one as well too, which is we got some clarification last year, end of last year, just around tax deductibility of financial advice fees. And so, it was more of a reconfirmation, but a really good thing for like people to remember. Pretty much like not even financial advice fees, but like fees in general. If the fee or the cost is associated or has a nexus towards generating income, if that cost is like on the provision of you earning the income,
and it's linked to that
income generating activity, it's therefore tax deductible. All right, so that's number one. So is the advice fees helping you to generate income, investment income, so on and so forth? And in most cases, a lot of things we do, we can't say this for everyone, but a big portion of what we're doing is helping that happen. The second part, which was really good to hear in clarity, was registered financial advisors who are also registered with the Tax Practitioners Board, if they're giving advice in regards to tax advisory. So like we just spent half of this podcast talking about tax structuring, contributions, what do we do? All of that falls into tax advisory advice. And so similar to getting tax advisory advice from an accountant, tax advisory advice from a licensed financial advisor, like I've explained, also tax deductible.
Yeah, correct.
So I think it's something that does get missed, JK, a fair bit. I know our clients don't, but it's something that, especially if you're paying for them out of your pocket, like some are paid within super funds and stuff like that, different story. The super fund will sort out that, not you. But I think that's another one, JK. Self-employed, I think there's always things getting missed. I think this is a really good conversation to have with the accountant before the end of the financial year. Yeah. Like for me, even individual tax returns, like people DIYing them, like if an accountant's willing to do your individual tax returns, like it's worth
I think so
seeing an accountant, like making sure that they're asking you the right questions, making sure you're not missing anything as well too.
Yeah. And I know most accounts send you a list of things that, hey, this doesn't necessarily apply to you, but it may apply to you. Let us know if it does. Yeah. Make sure you go through that list as well, because we picked up for a client, for example, and I know this might sound obvious, but we picked up that their interest on their investment properties wasn't actually claimed on their tax return. And that worked out to about $30,000, $40,000 a year in tax deductions. That's massive, and it's just one small thing that basically got missed.
Yeah, get it. So there's some pretty ones that kind of off the top of my head that I think of as well too.
Yeah, absolutely. And what's your top advice for effective tax planning heading into the new financial year?
Have a plan. I think most people are winging it.
Yeah.
I think most people just like go to the accountant, work with the accountant, but the events have already happened.
Yep.
Like, end of financial year is probably a reminder that if you've rushed or not doing anything, that you need to get a plan in regards to working with an advisor about how do I tax effectively build wealth.
Correct.
Yeah. 3 main things erode at people's wealth. Main ones. Unnecessary fees and interest. Donations to the tax office, which we just spoke about. And the third, stupid and dumb decisions with their money.
Yep.
Okay? There's other fourths, asset allocation, stuff like that. But what's the saying? If you're not planning, you're planning to...
Failing to plan is planning to fail.
They're the one. Yeah. And it rings true. Like, I think that's the main thing. Like, you need to have a game plan. You need to be executing on that game plan. You need to be having structure, not winging it. If you're winging it and you're being lazy with your stuff, you're not going to get epic results.
Yeah, absolutely. And I think another one, which isn't necessarily tax related, but it's in the financial year related, is around, like, for a lot of our clients, for example, a big part of what we do is around focusing on increasing your income, whether you're employed, self-employed. We try sort of set some income targets for our clients to make sure that they're achieving their goals. Now's a good time of year to start going, well, in the next financial year, I want to start to plan to earn X. What do I need to do from July 1 to actually get there? So I think it's
what conversations I need to have, what's going to take for me to earn that amount, 100%.
Yeah.
Great tips. Now, hopefully that's given you some nice food for thought and got you prepared for the end of the financial year this year, but also how to think about the next financial year as well and moving forward. So if you're liking these podcasts, make sure you like and subscribe, share them to your friends and family. JK, once again, thanks for joining.
Thanks,
and
mate.
for everyone, thanks for joining us as well. Cheers.
Thanks, everyone.